Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are coming off a massive high because we've just had our interview with Andrew Twiggy Forrest. I was pretty nervous for that one. That will be coming out on your podcast player or on YouTube, wherever you're watching or listening, next Tuesday. So make sure you're subscribed because you don't want to miss that. It was a fiery interview. It was a good interview.
Not in a bad way.
No. Twiggy was fired up.
He was fired up.
Yeah.
It came in hot.
But look, this episode is also going to be full of fire. We're coming in hot today. We got a lot to cover. We're going to talk about the news of the day because there's been some big news in some big ASX listed companies, which we both own. We're going to talk about leveraged ETFs. Beta shares have been going hard in the leveraged ETF space, and we're going to speak to someone from Beta shares about how they fit into an investor's portfolio. And we're going to close with Not Financial Advice, our segment where we look at some of the worst financial advice we've come across on social media. But Bryce, before we get into all of that, one big piece of housekeeping.
Yes, that is the Sown Hearts and Minds Investment Conference is coming up. And Equity Mates, we have an opportunity for you to join online and watch some of the best investors from around the world pitch their best idea for 2024. So the conference is on Friday, 15th of November. It's down in Adelaide. If you can't get a ticket down there, as I said, you can join online. Head to sownheartsandminds.com.au/virtual. We'll include a link in the show notes to grab a ticket. If you use the code EquityMates2024, again, we'll put it in the show notes, you get 20% off the virtual ticket. That's $500 down to $400. Now, tickets go towards the foundation that drives medical research at the Sown Hearts and Minds conference. And as I said, you get to listen to some of the best investors from around the world pitch their best idea for 2025.
News and markets.
All right, Bryce. Well, news of the week. It has been a tough week to be a founder-led business.
News of the week. So on Monday, WiseTech shares fell 15% as its founder Richard White managed a personal scandal.
Yep.
Nick Scali, led by the son of founder Anthony Scali, issued a profit warning, and on Monday again, shares fell 7%. And on the same day, Mineral Resources fell 14% as their founder Chris Ellison stood accused of operating an offshore tax evasion scheme.
Yes.
Not ideal.
Yeah. Now, a lot to unpack there, but it was a tough start to the week for some of these founder-led businesses. Arguably, we're stretching the definition of founder-led with Anthony Scali,
yes,
son of founder. But I thought there was enough similarities, like still like a major or controlling shareholder who's like heavily incentivized and aligned with investors, It's in his blood. I don't know.
Yeah, it's family.
But look, I think the Richard White one, we don't want to talk about the details because it is a personal scandal. I don't think it's worth us talking about. But the WiseTech board are investigating, and there's arguments that it's a distraction for WiseTech. And so shares are down. We're down 15% on Monday. They were down like 21% in the past 5 days. The Mineral Resources one, I think we can talk more about. MinRes is also down about 20% in the past 5 days, 14% in 1 day. And it wasn't just that the leader of MinRes, Chris Ellison, was stood accused of operating an offshore tax evasion scheme. He actually admitted to the Australian Tax Office that he was.
Yeah, it's a wild story. So he self-reported undeclared revenue.
Yeah.
Went to the ATO and said, look, I'm going to report this if you cut my penalty by 80%.
Yes.
So did a deal with them effectively and came forward and admitted what he'd been doing. And among other things, like to shed some light, one of the things they were doing was setting up offshore vehicles in the British Virgin Islands, buying equipment and then reselling it back to Mineral Resources at like 4 or 5 times value, and profiting from that. So there are many things going on, but yeah, it's fascinating. I didn't know that you could actually bargain with the ATO.
Yeah, well, you can understand it from a regulatory point of view. It's like the ATO accepts 20 cents on the dollar in terms of punishment, but they don't have to investigate, they don't have to prosecute, and they don't have to prove their case.
Yeah.
So from I guess it's in a similar world to why prosecutors allow plea bargaining.
Yeah.
It's like a resource efficiency in regulation.
80%.
I know, yeah.
He's known as the king of deal making.
Yeah, good deal in the end. That model is not a new model for business. That Microsoft had the classic example. They set up a factory in Puerto Rico, and there's a favorable tax advantages there for. It's part of America, but it's not a state. Anyway, favorable tax advantages in Puerto Rico. And Microsoft, I think they sold all their IP to Puerto Rico, and then they were licensing it. Microsoft in Seattle was licensing the IP from Microsoft in Puerto Rico. And so Puerto Rico was making bank like licensing their IP. Yeah. So like that's a model. It's evasion though. It's not. It's like it's illegal.
Definitely.
Yeah. What's the other one? Minimization.
Yeah.
Minimization is okay. Evasion is not okay.
Yeah. No, what he's done is not. It's not good.
Yeah.
Absolutely.
So look, here's the question now. You spoke about buying MinRes recently on the podcast.
Yep.
I have owned MinRes for a while. I'm also a long-term holder of WiseTech. So I think it's worth asking both of us, does it change our thesis on either of these companies?
No. At the end of the day, like I think, sure, you could probably say that you might put into question Chris's judgment, like not a great thing to do. But in terms of like the underlying operations of the business, and for all the reasons that I invested in it, him getting busted by the ATO doesn't really change that. If he went to jail, on the other hand, and really was stripped out from being able to actually run and manage the business, like he's so deeply entrenched in that would probably be a reason I would say, oh, hang on, like what's the impact of this? Who's going to come in? But that's not the case at the moment.
Yeah, I tend to agree. Like, doesn't change the thesis on the company. And I think it's like, it's part of the risks and perils of founder-led businesses. It's like they tend to do better, but they also just tend to sometimes be controlled in ways that you don't love by their founders. But for me, it's like, as long as these founders can still do what they do, you know, like the board doesn't put heaps of restrictions on them or they don't get booted, then nothing about the actual business of WiseTech doing global logistics software or the business of MinRes doing iron ore processing and lithium mining, like that hasn't changed.
Yes. Yeah.
And so, to be honest, I'm probably going to take it as a buying opportunity.
Yeah. Well, it's, as you said, it's for Mineral Resources down 25% since the 7th of October. So opportunity.
Now, speaking of founder-led businesses, it is earnings season in the US, and we wanted to talk about one company that has caught our attention. The founder we're talking about, well, the co-founder we're talking about is Reed Hastings. The company is Netflix, and the headline is Netflix is back.
Netflix is back. Look, it's been back for a while. They've been consistently upgrading reporting season on reporting season, and we know that that's a very positive sign. However, what we mean is they're actually now back past their previous high when that 2021 period, that was their previous high. And then two things happened. They announced that they were going to be cracking down on password sharing, and they also started losing subscribers in early 2022. And the stock absolutely bombed, down 75% between the end of 2021 and 2022.
Which was always, losing subscribers was always a bit of a beat up because a lot of their loss was Russian subs.
Yeah.
So, down 75% between October 2021 and 2022.
Yeah.
Like 3/4 of the value of Netflix was wiped.
Yeah.
We spoke to Hamish Douglas, who before this happened said that Netflix was on path to become $1 trillion company.
Yeah.
It very quickly became like $100 billion company.
Yeah. But it's since up 340%. It's done an incredible job at essentially executing what they said they would. They've cracked down on passwords and forced people on, not forced, but provided a cheaper ad-supported tier that is now getting more users and putting more top-line revenue.
Yeah.
So
I don't have ad supported on Netflix, but I have ad supported on Amazon Prime. It is killing me.
But I haven't opted in for that. I should.
No, because it's like, I think it's now we have to upgrade our tiers to get rid of ads.
God.
It's like the minimum tier is now ad supported, and that's what we started on. There was one ad break. I got 6 ads in a row on Amazon Prime, and you know how on the corner it's like 1 of 6, 2 of 7. Come on. Anyway, we're not talking about Amazon. So down 75% between October 21 to June 22, then up 340% since then.
Yeah.
For those who can't do that maths quickly in their head, that means if you had bought right at the top in October 2021 before Netflix lost 3/4 of its value and you just held, you'd be up 12%.
Yes. Yeah. It would have been a wild ride.
So it's back.
It's back.
It's all the way back.
It's absolutely back. And
it's now
as I said,
it's now a $330 billion company.
Still a way to go to the 1 trillion that Hamish thought. But look, they're doing all the right things. The thesis is playing out. It's getting access to markets that don't necessarily have the means to be able to afford the non-ad supported, and subscribers keep growing. Interestingly, I think it's the last report that they're going to do, or within the last few reports, that they're actually going to release their subscriber numbers. They think that,
what?
Yeah, they think it's a metric that is not important anymore,
and that
it's going to be focused on like profit and a few other financial metrics.
That's a red flag for me, straight up.
They had announced it a while
It's still
back,
a red flag.
but it's now coming to that point.
Put it this way, if they were still growing subscribers 20% year over
They'd
year,
be willing to do it.
They would be sharing
I
it.
agree.
Yeah.
I agree. Yeah.
So they're at 282.5 million global subscribers.
Yeah.
And by the sounds of the scaredy cat reporting
They've reached
over at
their
Netflix, they've hit a saturated market.
Yeah, it's how much can they now extract, I guess, per user.
This is something that frustrates me. It's a separate conversation, but like companies being able to choose the metrics they report. Obviously, there are accounting standards and you have to report like revenue, pro forma profit, but like,
it's like, we're a podcast business, but we're going to tell you how many live events we do a year.
Yeah, it's like investors should have more say. And maybe this is where like global giant pension funds and super funds could start throwing their weight around a bit more. But like, get Netflix to report its subscriber numbers. Come on.
Yeah.
Get tech companies to report monthly and daily active users. Like, give us standard metrics that are calculated in the same way that we can actually do proper comparisons. Anyway, gripe over. That's a conversation for another day. I think as we close out this Netflix conversation, this is just another in a long series of reminders that even really well-known and large and great companies have periods where they fall, they underperform, and those are those buying opportunities. In our book, Get Started Investing, we looked at some of the best performing stocks over the past 10 years in the US, UK, and Australia, and they all had massive periods where they had sell downs where we could have been buying.
Yeah. Missed that.
So just be patient because the opportunities will come, I think is the lesson. And then be opportunistic.
Yes, have some cash on the side. So as many of you may know, Ren and I recently released our portfolios.
Yes.
And 2 of my core positions are leveraged positions, both with beta shares, GGUS and Gear. And it has created a lot of conversation in the Facebook discussion group about the role of leverage and also particularly the role of leverage long term. It's something we've spoken about on the show a number of times. So we thought, why not just go straight to the source, bring in the experts, put them in the hot seat, and ask them all the questions that have come through from the community. So in this segment, we're bringing in investment strategist from BetaShares, Cameron Gleeson. Cam, welcome.
Thanks for having me, guys. Great to be here.
So Cam, let's start generally about leverage and gearing, and then we'll talk more specifically about all the mistakes Bryce is making. So just generally gearing or leverage, why would people use it as an investment strategy?
If you think about the way that people have sort of conventionally thought about investing, often we talk about young investors investing most of their assets into equities, and then as we get a little bit older into retirement, we might dial down that amount of equities, the growth assets, and have more defensive assets. This is sort of that traditional, conventional glide path of asset allocation. That approach to investing doesn't necessarily make sense to all investors. And I think what we'd say is that gearing is not necessarily going to be a solution for everyone, but it probably can play a role with more investors than you think. Where gearing is really powerful is that if we think about, how much it costs to buy a house these days or how long people are living, ultimately the number one risk we face may not be risk or volatility or, a sell-off in markets. It might be building up enough capital to reach our financial aspirations or indeed to last the rest of our lives. And the great thing about gearing or leverage is it allows us to use capital that we don't have today to put into the market and compound returns over the long term.
And if people are hearing gearing and leverage and they're not quite sure what that means, I think the best way to explain it, to put it in an example that Australians understand, is when you buy a house, you put some of your own money down and you borrow money from the bank, and then you buy the house with that money as well. And leverage in investing is similar. You take some of your own money and then you amplify your buying power with someone else's money, and that allows you to buy more than you would otherwise be able to.
That's actually sort of a great, to jump in, it's a great example. We think about the growth in property prices over the last 10 years. We often say that Australian wealth has been built off home ownership. It's not actually the home ownership that's led to that growth in wealth. It's the ability to use leverage when you're buying a house. And the equity markets globally in Australia have actually outperformed the Australian property market. And it is a valid strategy to use leverage or gearing as you do in your own house. When you go and buy your house to live in, you can use that to access an interesting asset class like shares.
Now, when I was explaining that, I was a little bit careful, because when I was saying you take some of your own money and then you get money from someone else to invest in equities, it's not always that way. There's a number of different ways that you can achieve leverage when we're talking about leveraged ETFs and investing in the stock market. So help us understand some of the main ways that you can achieve leverage through ETFs and why BetaShares prefers a certain way.
Yeah, so the two ways that you would, most of the time you would seek to get leverage within what we call internally geared ETF. The first way is that you could have an investor come along with $100 to invest in that fund, and the fund manager can then go and arrange a loan. Say if that loan was, let's just say, another $50, and go out and buy $150 worth of shares, which are all held within the fund, and the $50 worth of loan is against the fund. That's what we call an internally geared fund. So that's there is a legal loan within that structure. The end investor doesn't have any relationship with the lender. It's all within the fund, so there's some advantages to that. Now, in that scenario, the fund itself holds the underlying shares that you're looking to get exposure to. The other way to get exposure would be what's typically called a synthetic ETF, which is where rather than the ETF going out and buying the underlying shares and using a loan to buy more of those underlying shares, the ETF might use, or the ETF provider would use, futures contracts. So go long futures, which are a leveraged form of investing. If I wanted to use to basically take out a position in futures, if I want to get $100,000 worth of exposure, I might only need to put down $5,000 worth of capital. So these are a derivative structure. Those two approaches can have pretty dramatic consequences for the tax outcome of tax-paying Australian investors. That first approach I described, where the ETF holds the underlying shares, benefits from the fact that normally when you're holding shares, you're going to be able to take advantage of capital gains tax discounts. So where you have a long-term investment, being able to get a discount on the amount of gains you make on a trust or an ETF, and having a lower amount of tax is a real advantage. That second approach of an ETF that uses futures will result in what are known as income gains rather than capital gains, and that often leads to higher tax consequences. So both of those two approaches can lead to, ideally the same overall pre-tax outcome, but very different after-tax outcomes. And we're very mindful of tax being a really important consideration. So when we are offering, and when we've been in the market, we're the leader in the market in terms of geared ETFs. We've always gone for a structure which has involved holding the underlying equities and essentially using a loan to do so, because that's a better tax outcome and a better end product for investors to buy.
So, Cam, one of the most common questions that we get through the Facebook discussion group is around the term beta slippage. And is it something that we should actually be worried about holding these ETFs? So perhaps if you can help us understand what beta slippage is and then whether or not it's something we should be concerned about.
The term beta slippage is also sometimes referred to as volatility decay or the path dependency of rebalancing. They're sort of alternative descriptions I've seen used for that term. It's particularly an issue which is discussed amongst US investors with regard to US listed exchange traded funds. And I'll sort of explain why that is. In the US, we see quite widespread use of 3 times leveraged exchange traded funds. So funds that are trying to give you 300% exposure to the daily movements of an underlying asset, whether it's an individual share or an index. Now, the funds that we have available in Australia are a much lower level of leverage. But with those funds in the US, they do 2 things. They firstly have a very high level of leverage. They also rebalance on a daily basis. You know, when you're looking to rebalance on a daily basis, what that means is, let's just say if you had a 3 times leverage US ETF, if the underlying asset fell, that means I would be closing out some of my exposure, or in the case of, say, physically held shares, I'd sell some of those shares to, after that day's movement, retain exposure at 300%. And then if the price then ratcheted back up, I would then need to go and buy some additional shares to get back to 300% exposure. So you've got this daily rebalancing mechanism, but also when you are 3 times leveraged, the amount of trading you need to do to get back to 300% on a daily basis is relatively significant. Now, the very action of doing this rebalancing when a share market is trending in one direction and then reversing means that you can see a degree of underperformance. In that example, if the share price fall was 5% on one day and then it rebounded back up to by a bit more than 5%, back to its original starting point, you might see that ETF slightly underperform, right? So the nature of rebalancing means that generally speaking, rebalancing will help you with the market's trending both up or down, but if the market is range bound, it can work against you. Now, there's a couple of things that we do when we're offering geared exposures to Australian investors. Is that firstly, we recognise that Australian investors aren't necessarily using these ETFs as day trading vehicles. So US investors will often use their leverage funds just to trade in and out on a single day. So they want that very high level of leverage. Our investor base tends to be a bit more buy and hold. They hold for longer periods. So having a lower level of leverage, but also not necessarily rebalancing on every day, but rebalancing within a range, means that firstly we have less turnover, so less tax consequences from lower turnover, but we also have a lot less of this beta slippage or volatility decay within the final outcomes that investors get from investing in these funds.
So, Cam, we set up this segment by talking about how Bryce had shared his 2 geared ETFs that sit in his portfolio, and there were questions about whether they make sense as a long-term investment vehicle. Let's just ask you straight up. Should we be thinking about leveraged ETFs as long-term core positions, or is Bryce an idiot?
let me just tell you, those 2 ETFs that Bryce held, and obviously past performance is no indicator of future performance, but they have been 2 of the best performing funds out of both ETFs and unlisted funds available in Australia over the last 5 years. Their point-to-point returns have been outstanding. One of the benefits of gearing is it's actually probably the easiest way to create the most likely chance of you outperforming the market. For a geared exposure to outperform the ungeared exposure, you simply need to see a rate of return greater than your cost of borrowing. And so those funds have both done incredibly well over a long period of time. They do come with some volatility, and so you need to be mindful of your tolerance for risk, and that's obviously the trade-off with gearing is being able to stomach that volatility. You mentioned GGUS and gear, where we see people use those funds. I actually was talking to an advisor client the other day. They're actually quite sometimes quite active in using those funds, so rebalancing, reallocating to a geared exposure after the market sold off, and we can see some really good outcomes for people using those funds and in fact using downturns to buy back in, and they can be a really effective tool for building wealth. And I think if you look over the long term, the returns speak for themselves. So there certainly have been, outstanding performers, but you need to be mindful of the level of volatility involved in those funds. Those funds have an exposure on a daily basis between 200 to 280% of a day's moves. And it's just being mindful of that and comfortable with that level of exposure. Noting that there can be some pretty substantial upside, as Bryce has no doubt enjoyed.
And the downside.
Yeah. And I think that probably leads to the less geared funds, G200, which is a geared version of A200,
That's right, yeah.
GNDQ, which is a geared version of the NASDAQ 100, and GHHF, which is a geared version of DHHF, the Diversified All-World Growth. Do they make more sense than the one Bryce is using for long-term core positions?
Look, it depends, right? It depends on your volatility tolerance and how active you are in using these exposures. They're wealth builder funds, which, as you described, G200, GHHF, and GNDQ, are designed to be a much lower level of gearing. So they have what's known as a loan-to-value ratio of between 30 and 40%. So you have an exposure to the markets on a daily basis of around about 1.5 times the underlying assets price. That means that they tend to be a lot more truer in terms of their long-term returns. You get less rebalancing. We did talk about rebalancing before, that can work for you and against you, but less rebalancing. And I think if you are someone who is going to be more hands-off, having a lower volatility and a less sort of hot sauce exposure to gearing can really make sense. And where we're seeing people look to use these more moderately geared funds, the wealth builder funds, is more of a dollar cost average approach. So if I'm able to put away $1,000 a month, that may not sound like a lot today, but by using gearing, I can start having more exposure to the market today. If I continue to invest $1,000 every month, if I can put that aside as part of take that out of my paycheck and put that into the market with a moderate level of gearing, it also means that I'm continuing to contribute capital. So if the market does sell off, I'm buying when shares are cheaper, and hopefully I'm able to sort of participate and accelerate in the upside too. So I think they're an excellent solution, and we're already seeing a lot of popularity for these funds.
Yeah, I can imagine GNDQ getting a bit of interest over the coming months as people start to find out that that's available. So I guess just to summarize there, Cam, overall I'm okay. That's the takeaway. That's the takeaway for me. But really, it's that beta slippage is a thing, but it really comes down to not necessarily how the ETF is constructed, but more the level of gearing and, to some extent, how frequently it is rebalanced. That is just part and parcel with having leveraged ETFs. And then there are products available that are more appropriately designed with less leverage that are more appropriate for the longer term for those that are interested in it. That's kind of my key takeaway here.
Yeah,
I think so. I think that's a good summation.
Nice. Well, hopefully that keeps the questions at bay for at least 24 hours, but I'm sure they'll keep coming. But Cam, thank you so much for your time. We really appreciate it.
Thanks, guys. Great to be on.
Well, hopefully that answered some of the questions if you have the leverage positions in your portfolio. There are plenty of questions coming through. If we weren't able to answer all of them for you today, good news is we have a professional here to help, and that is Adam Dawes, who is one of our experts on Pimp My Portfolio, who you would have heard before. Adam is now offering professional portfolio health checks. It's the opportunity for you to sit down with him to get personalized investment portfolio review. He'll give his guidance based on your goals and risk profile and where your portfolio can improve. It includes a tailored statement of advice for your portfolio, and it's exclusive to the Equity Mates community for just $750. So if you would like to sit down with Adam and the team and get that health check, head to equitymates.com/advice, or we'll include a link in the show notes. Now we're going to take a quick break, and on the other side, we're going to be doing a roundup of some of the worst financial advice on social media. We'll be right back. Welcome back to Equity Mates. It is time for one of our favourite segments, Not Financial Advice.
This is not financial advice.
All All right, Bryce. Well, I've got 5 of the worst pieces of financial advice or just worst financial content that we've come across online. You haven't seen them, so I'm excited to get your reactions.
Yes.
For people listening, you can jump over to YouTube and watch the videos along with Bryce. But let's get into the first one.
When you're betting on sports, you know the team, you know the players, you know the point spread, and you get paid right after the fucking game. On the stock market, do you really know these companies? Do you know the day-to-day operations? Do you even know where the company's at? Do you know who's running the company? No, you don't. I can get you key elements and inside information on particular games that you cannot get in the stock market or have any clue on how to find valid information. So I just want you guys to really think about it. If you're going to invest, there's a lot more money to be made in sports betting than there is in the stock market. And I know there's going to be guys that come in and put comments, I'm making tons of money in the stock market. Well, you obviously aren't betting sports, because if you were and you were to compare the two, I can show you how to make a lot more money betting sports than you're getting in the stock market.
Oh my God, I don't even know where to start with this guy. Everything that he said there, you can find very easily online. Do you even know who runs the company? Dude.
Yeah.
Yes.
Yeah. Sports betting
Love the glasses.
Sports betting is a defined odds structure where the house is always wins.
Yes.
Yeah.
I don't think he'd understand that concept.
The stock market is unlimited upside in a sense. Like, it's not defined odds. It's anyway, we don't need to argue it, but it's also just like they're two fundamentally different things.
Yeah, absolutely.
And sure, you can treat the stock market like a casino, but that is certainly not how we approach the stock market.
Throw to our very first YouTube video, I think that we did called betting versus stocks.
Yes.
Yeah, I think stocks came out on top, I think. All right, next.
All right, maybe we cut that for not the ringing endorsement that it was. All right, but here is video number 2.
So people keep asking me, how are you so rich? How are you so wealthy? How are you affording all these cars? I actually don't even use my own money to buy all this. I buy all my real estate with the bank's money, all my cars with the bank's money. I don't even use my own money. You can actually buy cars like these just like I do with no money down, none of my own money at least. So what I do is called leverage. So what I do is I go over to the bank, get money from the bank, use it as a down payment on a house, either apartment buildings, and the money that comes back, it's all mine. If you want to learn how to be rich like me, follow for more.
All right, I don't think this guy owns any of those cars.
No, definitely not.
No way.
Well, that's always the way with these people.
I reckon we should do a parody video like this. He's got a shitty white shirt on. He's walking around in a car park with a couple of power cars.
The thing though is people don't get the sarcasm online because like.
Is he meant to be sarcastic?
No. This is what I say on TikTok every day.
Yeah. His thing is go to the bank and borrow money.
His thing is borrow
heaps of money. Borrow heaps of money. No. Leverage in housing, yes. That is a thing. Leverage in buying sports cars, that's not a thing.
Yeah,
that's just borrowing money.
Well, all of it's just borrowing money. Nothing is new about it.
No.
And you're also not a millionaire if you own assets, but you just have heaps of leverage.
Yeah.
Don't borrow to buy a depreciating asset. That's of all the problems with America's financial system, the fact that it's such a car loan culture over there and everyone borrows so much at high rates of interest to buy depreciating assets kills me. Just kills me.
Some people think housing's depreciating, which it could be.
Not in Australia.
Not in Australia. Like you have to upkeep it, if that makes sense. You know what I mean? Like,
oh, bro, last time you started speaking about how you don't always make money on housing, you got rinsed in the YouTube comments.
What that segment, looking back on it, we shouldn't have just compared it to equities. It should have just been straight up principal place of residence, don't put your eggs all in one basket. That's the message with that.
Yeah. Well, Bryce, speaking of not losing money, how's this advice that I came across?
Warren Buffett was once told in the 2008 crash, Mr. Buffett, you have lost $10 million today. Do you know what he said? He said, I haven't lost anything. I haven't sold. Me and Buffett have the same mindset. I'm tens of thousands in loss on my Euro USD trades, but I haven't lost anything because I haven't closed the trade. No stop loss. We share that mindset and inshallah, the markets will turn around and I will be profitable. That's the problem with these traders nowadays. Stop losses, closing their trades. Don't close, don't lose. Exactly, yeah.
I don't mind that.
No.
Firstly, out of all of these, I'm seeing that you and I really need to improve on our kit. Chains, sunnies. What we're wearing in studio. We're behind the 8 ball on all of these guys. I might come in next time for the next segment, remind me, I'll dress up.
Okay, all right. We won't edit that out. You're going to have to do that.
But yeah, technically he's not wrong.
No, well, I mean,
He hasn't like actualized the loss.
Yeah, but
On
him saying that people who are trading, especially he was trading currencies, not having a proper risk management framework, like stop losses, stupid.
Yes.
Warren Buffett is not trading short-term trading currencies.
All right, what's this one? I'm going to be a millionaire.
I'm going to be a millionaire before I'm 20, and this is how. I work for my dad's company. I have a contract with them, and I get paid every month. That money then goes into real estate, where I get some passive income I get to go spend. I never get to touch that principal income. So every year, that principal doubles, triples, it stacks on top of each other, and over time, that principal in real estate will make me a millionaire. By the time I'm like 20 years old, I have like 600, 800,000 in real estate from that agreement we have.
That's not a million.
I know.
So 600,000 to 800,000 is not a millionaire. So not a millionaire. Secondly, the income that she was taking from that, she said she was going to go and spend, and she reckons housing is doubling every year.
Well, also,
and she works for Daddy's company.
That was, I reckon the video could have been this long.
I'm going to be a millionaire before I'm 20, and this is how. I work for my dad's company.
You already are a millionaire. Congratulations.
And look, nothing wrong with that, but like if you're that, so that's Grant Cardone's daughter, and if
who's Grant Cardone?
You and I live in different social media worlds. He's like a real like spivvy, like sell you a financial course. I invest in real estate. Yeah. Big in America, massive. Like videos on private jets, blah blah blah. But like terrible financial advice. If you're in that situation, just don't make social media videos about it, telling other people how you're going to do it.
Yeah, at least if you're going to tell people how to do it, make sure it's right.
So every Friday, if you enjoy these videos, the cringe and the terrible advice, we do a roundup every Friday on our Instagram, so go and subscribe there, because this is just the tip of the iceberg. As sad as it is, there is so much bad advice.
What would we become
if
we tried doing that?
Probably bigger than we are right now. Anyway, look, I think that does it for today. If you want some general financial advice that isn't in that style, head over to our sister podcast, Get Started Investing. Bryce and I break down all the basics of investing, the steps you need to get started. So get off TikTok, get off Instagram, and get on the podcast app. That is the place to learn to invest.
The next episode, we go deep on our savings rates.
Okay, there you go. You see, that would not make good TikTok content, but hopefully it's a little bit more useful. So that will do it for today. Thanks, everyone, for tuning in. Make sure you're subscribed so you don't miss an episode. Twiggy Forrest interview dropping next week. You don't want to miss that. But Bryce, speak to you next time.
Love it.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.